Is the US economy secretly cracking under the surface while stocks hit all-time highs? In this video, we'll dive deep into the latest jobless claims data just released, skyrocketing unemployment across key demographics, and the curious decoupling between the stock market and the labor market in November 2022. We did just get jobless claims. Remember, the government is reopening, so we are starting to get data again when it comes to the labor market. So what is the state of the labor market? How strong is it really? Initial jobless claims actually fell to the lowest level going all the way back to April. Again, I think it's important to show a moving average with the volatile week to week sort of data set. Here we see a 6-week and a 12-week moving average. We can see that has been relatively flat at about 220,000 initial claims per week. Zooming way out, I think it's important to point out that initial claims are quite low compared to historical average, up here at about 320, 330K per week. We can see initial jobless claims, while they have been kind of ticking up over the past 3 years or so, they are still quite low compared to the historical average. So while the labor market has been weakening, while it has been initial claims have been ticking up, they are still quite low when you look at that historical context. So continuing jobless claims. This is just what it sounds like. Those folks that are not filing for unemployment for the first time, but they are continuing a jobless claim. We can see that came in at 1.96 million, about 2 million folks that are continuing claims when it comes to unemployment. But again, looking at the historical context, this continuing claims number is quite low. Now, it is right around the level that we saw going into .com. It is lower than the level that we saw going into 2008. Of course, in a recession, you see continuing claims and you also see initial jobless claims just start to go vertical. We have not seen that as of yet. And I think that given the week to week volatility, we should wait for the 6-week or maybe the 3-week, 4-week moving average to start ticking up because as you can see, there are periods of time where for whatever reason, week to week, you get a spike in initial jobless claims. So I think it's really important to look at the moving averages. But again, going into recession, you see this kind of ticking up, a gradual tick up in continuing claims and initial claims. And then the recession hits and it just goes vertical. Both .com 2008, of course, here as well, and of course 2020, where initial claims and continuing claims just went to the stratosphere. So looking at the unemployment rate, here is U3. This is the unemployment rate that you will hear the mainstream media report on. This is U3 unemployment, 4.4%. And as you can see, I'll put the cursor over 4.4. That is actually quite low compared to historical average, going all the way back to the 1950s. However, it has started to tick up in a pretty noticeable way going back to the springtime. And so I think U3 is one to watch because, again, remember that you get that sort of gradual tick up before the recession, then the recession hits, and of course, it just goes vertical. So we are starting to get a little bit of that. So I think it's important to keep an eye on the black unemployment rate. Now, the reason that I'm showing this is this can actually be a little bit of a leading indicator for where U3 ends up going. And look at what has happened over the past couple reports. Black unemployment rate has gone vertical from about 6% to 7.5%. Now, again, this is quite low compared to the historical average, but it can be a leading indicator for where U3 ends up going. So I think that that rise, coupled with the fact that even U3 is starting to tick up in a noticeable way over the past couple reports, I think that the labor market is definitely worth an extra look. So here, moving on, we're going to look at U6 unemployment rate. This is arguably a much better way to measure unemployment. It includes those marginally attached to the labor force, those that are part-time for economic reasons, that sort of thing. So it's a much broader way of measuring unemployment. We can see U6 unemployment rate nearly double what the U3 headline unemployment rate would indicate. So, again, a much better way of measuring unemployment. This does not look so low compared to the historical average. Look at what it was going into 2019. We can see it was about 1 percentage point lower. However, right now it is at 8%. Now, this is not ticking up in the same sort of way that black unemployment rate is. But again, I think the labor market is weakening in a pretty noticeable way, and I think it's worth keeping an eye on. We'll go through some of the ISM metrics, which show that the labor market has been weakening, arguably for the past 3 years, in a pretty noticeable way when you look at ISM PMIs. So to finish up here, youth unemployment. So I think this is the most important story when it comes to unemployment. It is at 10.5%, and I'll put my cursor over there. You can see that this is actually quite elevated when you compare it to the historical average. Look back all the way to 1951. You can see this youth unemployment rate of 10.5% is actually quite elevated compared to the historical norm. And again, it is starting to curl up and go vertical, just like black unemployment is. Youth unemployment, also similar to that black unemployment rate, can be a leading indicator for where U3 ends up going. So when the mainstream media reports 4.4%. Yes, that is the U3 unemployment rate, but is not the most accurate way of measuring the true state of the labor market. Now, moving on to my now viral post showing total job openings and the S&P 500. I put this out a month or two ago. Most people have probably seen this. I think it's important to point out that Challenger Gray and Christmas job cuts report that came out about a month ago showed that when it comes to why firms are laying off individuals, the second most cited factor is AI. So yes, there were other things that changed in 2022. Of course, the Fed started to hike rates. There were other factors that might be going into this, that might be playing into this. But I do think that AI is going to need an extra look when it comes to the effect that it is having on real human beings in the real economy in the U.S. labor market. We can see the S&P 500 has just gone straight vertical, while, by the way, job openings are declining and basically remaining quite flat. Now, I want to point out, though, that when job openings remain flat like this, and then they start, the rate of deceleration starts to kind of slow down, generally that is a sign that you are early cycle in the business cycle, and you're probably going to see an uptick in job openings. I did a video about a month and a half ago, 13 charts that show that we just came out of a recession. I will try to link that at the end of the video. Job openings and the rate of change of job openings was one of the charts that I showed in that video. That rate of change is starting to decelerate and starting to tick up, meaning that, again, we might be early cycle. So some conflicting data points when you look at, for example, unemployment, which is starting to tick up and go almost vertical when you look at black unemployment or youth unemployment. Now, to finish up here, ISM Manufacturing Employment Index and ISM Services Employment Index. Remember that manufacturing plays a very small role in the U.S. economy. The vast majority of our economy is services based. Well, if we look at that manufacturing employment, it has been below 50, which, by the way, with the ISM index, anything below 50 is contraction. Anything above 50 is expansion. So we have been below 50 on the ISM Manufacturing Employment Index going all the way back, arguably, to early 2022. That was really the last time that we spent any sustained amount of time above 50. If you look at ISM Services, it is a little bit better. It is kind of vacillating around that 50 level, but we have been in contraction according to ISM PMIs for the services, which again is the vast majority of the U.S. economy, for the past 4 or 5 months. So the labor market is clearly weakening. The question is really, are we coming out of a recession or are we going into a recession? There is some conflicting data. Again, 13 charts that show that we just came out of a recession. I would highly recommend everyone go watch that video if you have not seen it already. Continuing claims, unemployment. This looks like we might be going into a recession. However, the rate of change of a various wide range of metrics, job openings being only one of them, show that we might actually be coming out of a silent recession that was not, of course, declared because we didn't get the metrics needed for the NBER to define a recession. So I would highly recommend folks watch that video. It is a bit of a contrarian take. Most folks think that we are headed into a recession, but there's a number of metrics, 13 in fact, that show that we might have just come out of a recession. So anyways, hopefully that was helpful, and I'll catch you on the next one.